Most individual investors set out on their investment journey with high hopes and dreams of building wealth. They read the headlines, watch the markets, and try to make smart moves. But despite their best intentions, the reality is often much harsher than expected. In fact, studies show that most individual investors actually lose money in the stock market over the long term. This isn't just a matter of bad luck or picking the wrong stocks. It's a pattern that repeats itself year after year across all kinds of markets and economic conditions. The main culprit behind these disappointing results, it's the temptation to try and time the market. Investors often find themselves buying when prices are high, swept up in the excitement of a booming market, and then selling in a panic when prices drop. Emotions like fear and greed take over, leading to decisions that are the exact opposite of what's needed for long-term success. Even seasoned professionals, people who spend their entire careers studying the markets, rarely get market timing right. Yet the myth persists. Every day, countless investors chase quick wins, react to sensational headlines, and try to outsmart the market. The result? More often than not, they end up buying high and selling low, locking in losses instead of gains. This cycle of emotional decision-making is a recipe for disappointment and frustration. It's easy to feel like you're always one step behind, missing out on gains and suffering losses that could have been avoided. The truth is, trying to time the market is more like gambling than investing. You might get lucky once or twice, but over the long run, the odds are stacked against you. The market is unpredictable, and no one, not even the experts, can consistently predict its next move. But here's the good news. There's a smarter, more reliable way to invest. Instead of trying to guess the perfect time to buy or sell, you can use the natural ups and downs of the market to your advantage. This approach takes the stress and guesswork out of investing, and it's been proven to work over time. It's called dollar cost averaging. This simple yet powerful strategy involves investing a fixed amount of money at regular intervals, regardless of what the market is doing. By doing this, you buy more shares when prices are low and fewer when prices are high, which helps smooth out the impact of market volatility and reduces the risk of making poor decisions based on emotion. Let's take a closer look at how dollar cost averaging works and why it could be the key to building lasting wealth. No market timing required. Dollar cost averaging, or DCA, is a simple yet powerful investment strategy that involves putting a fixed amount of money into an investment like stocks or mutual funds at regular intervals, such as every month or every paycheck, regardless of what's happening in this market. Instead of trying to guess the perfect time to buy, you commit to investing consistently, rain or shine, bull or bear market. This means you're buying in whether the market is soaring to new highs or dipping to unexpected lows. The beauty of DCA is that it takes the guesswork out of investing. You don't have to worry about whether today is the best day to buy or stress over market predictions that rarely come true. Think of it like subscribing to your favorite streaming service. Once you set up your investment plan, it runs in the background automatically. You don't have to remember to make each payment or second guess your decision every month. It's a set it and forget it approach that fits seamlessly into your routine. By automating your investments, you remove the emotional roller coaster that often comes with watching the market's ups and downs. This helps you avoid impulsive decisions like panic selling during a downturn or chasing after hot stocks when prices are high. Instead, you stay calm, focused, and consistent. When the market is up and prices are high, your fixed investment amount buys fewer shares. That's okay because you're still building your portfolio, just at a slower pace. But when the market dips and prices fall, that same amount of money buys you more shares. Over time, this means you're able to take advantage of lower prices without having to predict when they'll happen. As you keep investing regularly, your average cost per share evens out. Sometimes you'll buy high, sometimes low, but over the long run, you'll likely pay less per share than if you tried to time the market perfectly. DCA isn't about being the smartest person in the room or making clever market moves. It's about building a habit of consistency, which is one of the most important traits for successful investors. You don't need to be glued to financial news or try to outsmart the market. Instead, you create a plan that works for your budget and stick to it, no matter what headlines say. Start by deciding on an amount you can comfortably invest each month. Automate your contributions so you never miss a beat, and let the power of time and compounding work in your favor. Remember, the goal isn't to perfectly time the market. but to spend as much time in the market as possible. The longer you stay invested, the more your money can grow. That's the real secret to building wealth that lasts. Not luck, not timing, but steady, consistent investing over time. Dollar cost averaging lays the foundation for financial security and peace of mind for you and your loved ones. Let's see how dollar cost averaging, or DCA, works in a real-world scenario. This simple strategy can make investing less intimidating, especially for beginners, and helps you avoid the stress of trying to time the market perfectly. Instead of worrying about when to buy, you simply invest a fixed amount at regular intervals no matter what the market is doing. Imagine you decide to invest £100 every month into a mutual fund or an index fund. You set up an automatic transfer so the money goes in on the same day each month, rain or shine. This way you're building a habit and making investing part of your routine, just like paying a bill or saving for a holiday. In the first month, the price per unit of your chosen fund is £10. With your £100, you're able to buy 10 units. It's straightforward and easy to track. The next month, the market takes a dip and the price drops to £5 per unit. Now, your same £100 buys you 20 units, twice as many as before. While a falling market might worry some investors, with DCA, you actually benefit by picking up more units at a lower price. In month 3, the market rebounds and the price jumps to £12.50 per unit. This time, your £100 only gets you 8 units. But that's okay, because you already bought more when prices were low, and now you're still adding to your investment regardless of the price movement. By the 4th month, the price settles back to £10 per unit. Once again, your £100 buys you 10 units. Over these 4 months, you've experienced the ups and downs of the market, but you've kept your investment plan steady and consistent. Let's add it all up. After 4 months, you've invested a total of £400. In return, you now own 48 units of the fund. This is more than you would have if you'd only bought when prices were high, and it's a direct result of sticking to your plan through market fluctuations. If you calculate your average cost per unit, it comes out to about £8.33. That's actually lower than the average market price over those 4 months, which is a key benefit of dollar cost averaging. By buying more units when prices are low and fewer when prices are high, you naturally lower your overall cost per unit. This approach helps you avoid the emotional roller coaster of trying to predict market highs and lows. Instead, you're taking advantage of market dips by buying more, and you're not overpaying when prices are high. Over time, this can make a significant difference in your investment returns. There's no need for guesswork or stress about when to invest. You simply follow your plan, knowing that you're building your portfolio steadily, 1 month at a time. This consistency can help you stay calm and focused, even when markets are unpredictable. That's the real power of dollar cost averaging. It's a disciplined, hands-off approach that works for both new and experienced investors. By sticking to your schedule, you let the strategy do the heavy lifting, and you don't have to worry about making the perfect move at the perfect time. Best of all, DCA works automatically, even when markets are volatile or uncertain. You can set it up once and let it run, knowing that you're investing through all kinds of market conditions without having to constantly monitor the news or second-guess your decisions. Over time, these regular investments can really add up, helping you grow your wealth steadily and confidently. That's the beauty of dollar cost averaging. It's simple, effective, and designed to help you reach your financial goals one step at a time. DCA forces you to buy more when prices are low, turning downturns into opportunities. Instead of panicking during market drops, your plan scoops up more assets at a discount. This lowers your average purchase price and positions you for bigger gains when markets recover. If you tried to time the market, you'd likely miss these bargains. DCA protects you from emotional mistakes and self-sabotage. It's a strategy that benefits from volatility, not one that fears it. Market dips become chances to grow your portfolio, not reasons to panic. That's a powerful shift in perspective. Fear of risk keeps many people from investing. DCA helps manage that risk by spreading your investments over time. If the market drops after you start, only a small portion is affected. Future contributions buy at lower prices. This staggered approach smooths out the ride and reduces the risk of bad timing. You won't hit the exact top or bottom, but you'll avoid the worst outcomes. DCA makes investing safer and more predictable for most people. It's a disciplined way to build wealth without the anxiety of lump sum investing. With DCA, you don't need to predict the market or wait for the perfect time to invest. No more agonizing over headlines or market forecasts. Just automate your investments and let the calendar do the work. This saves you time, energy, and stress. Whether the market is up or down, your plan keeps moving forward. You don't need to be an expert, just consistent. DCA makes investing accessible to everyone, not just financial gurus. It's a simple, stress-free way to start building your portfolio. Investing can be stressful, but DCA takes the emotion out of the process. By automating your investments, you avoid panic-driven decisions and stick to your plan. No more second-guessing or reacting to market swings. Compared to day trading, DCA is low stress and low maintenance. Set it up once, check in occasionally, and let it work in the background. This frees you to focus on what matters most in your life. Your wealth grows quietly, without constant attention or anxiety. Investing becomes a source of security, not stress. That's the real value of a disciplined approach. Ready to start? Here's how. First, decide how much you can comfortably invest each month. Start small if needed. Next, choose a simple, low-cost index fund or ETF for instant diversification. Open an account with an online platform or stocks and shares ISA. Set up an automatic monthly investment for your chosen amount. Once it's running, resist the urge to tinker. Be patient. Let time and compounding do their work. Don't panic during downturns. Remember, you're buying more at lower prices. Stick with it and watch your wealth grow over the years. Dollar cost averaging isn't flashy, but it works. It turns market volatility into your ally and removes the stress of trying to time the market. By investing regularly, you build wealth steadily and securely. It's the tortoise, not the hare, that wins the race. Start your automated plan today. The sooner you begin, the more your money can grow. This is about building a secure future, one step at a time. For more practical tips, subscribe and follow along. Your journey to financial well-being starts now.